The one thing we know about private equity is they remorselessly cut jobs even in good times. So you could have 1 to 2 million people lose their jobs in the United States, and then it turns into panic, and then it's a run on the bank.
How does a company with 95% of its stores profitable go bankrupt? Because that's exactly what happened to Jo-Ann Fabrics earlier this year. The answer: private equity, adjustable rate loans, and a debt-fueled buying spree that some say could be the next big financial crisis. My name is James Lee. We're going to get into all of that right now on Beyond the Headlines on Breaking Points. Private equity is a type of investment that pools money from institutional investors, like pension funds and endowments, to buy companies, typically using a lot of borrowed money. Over the years, however, private equity has shifted from rescuing struggling businesses to targeting fundamentally sound ones, businesses with steady cash flows and reliable customer bases. Furthermore, as the industry has grown, private equity firms have also moved beyond the national brands and corporate giants they once favored and are now buying up essential community-focused businesses like hospitals, retirement homes, vet clinics, funeral parlors, HVAC companies, and even car washes, gutting them for quick gains and either flipping them or letting them spiral into bankruptcy when the debt becomes unmanageable. And with private equity now sitting on trillions of dollars in adjustable rate loans and bankruptcy rates for their portfolio companies hitting all-time highs in 2024, some are warning that private equity could trigger the next big financial crisis. To help us break all of this down, I'm joined today by Jared Dillian, a financial author and former Wall Street trader who ran the ETF desk at Lehman Brothers from 2004 to 2008, giving him a front row seat to the global financial crisis. And lately, he's been sounding the alarm on what he believes is the next big bubble, private equity. Jared, thanks so much for joining us today on Breaking Points.
Hey, thanks for having me.
So before we dive into the bubble itself, I do want to talk a little bit about the mechanics of private equity. Specifically, I opened this segment earlier on with an example of Jo-Ann Fabrics, a PE-owned company that went bankrupt earlier this year despite 95% of its stores being profitable. So can you explain why a company that's so insanely profitable can still end up being bankrupt under private equity ownership? And when it does go bankrupt, does that itself also impact the profitability of private equity?
Yeah, so I can speak to that a little bit. First of all, let's just back up a second and talk about what private equity is. You touched on it a little bit, but private equity is when you have a private equity firm, an entity that borrows money to buy a private company, not a public company, but a private company, a private business. And you mentioned a bunch of them, car washes and vet clinics and dental practice and stuff like that. And the idea is they will hold them for a medium length period of time, 3 to 5 years, and they will do some managerial stuff to improve profitability, which usually involves cutting costs a lot and basically improving the financials so they can sell the business at a significant profit 3 to 5 years later. That's how it's supposed to work. I don't know the specifics of the Jo-Ann Stores deal, but I can tell you that private equity frequently does things like dividend recaps, right? And a dividend recap is when you have a private business in the portfolio and the sponsors will borrow a bunch of money to pay dividends to the owners, basically sucking money out of the business. And the one thing that should be said about private equity is that the difference between a private equity owner and a founder, the founder wants the business to last forever. Like whoever founded Jo-Ann Stores, they want it to last for hundreds of years. They want it to survive them. A private equity owner doesn't really care. They don't care if the business goes bankrupt, if they got their money out, right? So it's really about time horizons. It's about thinking very long term versus thinking very short term. And that I think is the fundamental problem with private equity in this country is that you have these owners with a short time horizon and they're really indifferent as to whether the business succeeds or fails.
So what you're saying is there's actually ways to pull money out of, say, Jo-Ann's Fabric, have them go bankrupt, but still make money for the fund.
Yes, and like I said, I don't know the specifics of that particular deal, but that happens a lot.
Okay, so then I want to ask you a little bit about one of these, many alarming statistics that I've seen is that private equity firms have taken out trillions of dollars. The number I was looking at was $3.8 trillion in adjustable rate loans, which is more than double the $1 trillion of risky adjustable rate mortgages that triggered the 2008 financial crisis. So I'm wondering, is this the kind of red flag you're looking at when you have said that private equity is the next big bubble? Or if not, what kind of indicators are you looking at that makes you think that private equity is a bubble?
Well, I mean, the adjustable rate debt is really an issue. I mean, if 10-year notes right now are 4.5%, if they go to 6.5%, and the interest rates on these loans go up accordingly, then that's a problem. Just like it was in the financial crisis. Like if you've ever seen The Big Short, they talked about these subprime loans. They had these teaser rates, and the interest rates go up, and people can't afford them, right? The thing I think that has alarmed me the most in the last month or two is the fact that university endowments are trying to sell their private equity holdings at a discount. And you saw that Yale was the first to do this. So Yale, the history of Yale is the Yale endowment was run by a guy named David Swensen, who really liked alternatives like PE and hedge funds. And he built this university endowment portfolio full of very illiquid stuff, but it beat pretty much all the competitors, all the other university endowments. And now, university endowments in particular are incredibly illiquid because they're loaded up on private equity. And Yale says, look, like, if we're going to panic, we want to be the first ones to panic. And they're selling 6 billion out of their portfolio, 6 billion of private equity, and they're willing to take a significant haircut. So my guess is that they'll probably sell it for 5 billion, somewhere around there. And then that calls into question the marks of the holdings of the private equity companies. If they have, say Joanne Store is marked at 2 billion and a large holder of private equity sells at a 17% discount, what does that mean for the marks within the portfolio? They probably should be a lot lower. And then they start lowering the marks, and then it turns into panic, and then it's a run on the bank, basically. Like that's kind of how I see this playing out, right?
Yeah, can you talk a little bit more about that? What would a bubble actually look like? Because we're not only talking, you have a bunch of endowments, but you also have, let's say, the pension funds, retirement funds being heavily invested in private equity through something called a collateralized loan obligation, CLO, kind of similar to what we saw in the financial crisis with CDOs packaging debt and selling that as a financial product. So, what kinds of repercussions could we be looking at if the bubble, if the private equity bubble does burst?
Well, one thing is that I think the last statistic I saw was that private equity owned companies employ at least 8 million people in the United States. Okay. And if there is a downturn in private equity and these companies are being liquidated, you will see very rapid job losses in the United States. So you could see potentially 10, 20, 30% of these positions go away. So you could have 1 to 2 million people lose their jobs in the United States. Veterinary practices, HVAC businesses, dental practices, stuff like that. They will go out of business. They will simply go out of business, and then you'll have less options. For sure, this is coming. Like this is absolutely coming. Um, there's a lot of people have, I guess the one point I want to make is private equity made sense 10 or 15 years ago, right? Because interest rates were zero and they could borrow a ton of money at very low interest rates, right? And valuations were very low. Like they could buy portfolio companies at 4 to 5 times earnings, right? Well, you fast forward to today, and interest rates are 4.5% on 10-year notes, and valuations are 10 to 12 times, and it just doesn't make any sense. And the problem is there are 10,000 plus private equity firms in the US. Investors are plowing money into them. They have so much money to put to work There's competition for deals. The valuations have gotten even more absurd. And if private equity is buying a business at 12 to 14 times, there's no way they can make money at it, right? So they're either going to sell it or it's going to go bankrupt.
So, in you mentioning bankruptcy, the term bailout comes into play because something is going to have to happen to backstop all of this because like you said we can't just have all of these services disappear. And thinking back to 2008, and I know you were there personally and you saw some of these things, we saw the government promise a bailout of the American working class, but ended up the bailout was just for Wall Street. And so what I'm wondering is this time around, I'm seeing some of the similar trends happening where a lot of the financial risk is being transferred to the working class again. Do you think that's kind of a fair comparison? Who's likely to end up holding the bag, basically?
Well, I think that this problem is on the White House's radar. I think they know about it. And it's kind of a slow detonating bomb, right? There's really nothing they can do about it at the moment. Would there be a bailout? Maybe. Who would they bail out? Well, just like in 2008, they bailed out. Well, first of all, to talk about 2008 a little bit. With TARP, the Troubled Asset Relief Program, the federal government took equity stakes in every bank in the country, whether they wanted it or not. But they disproportionately took larger equity stakes in the big five banks. They got 25 billion apiece. So if there were to be a bailout of private equity, for sure it would be the names like Blackstone, Apollo, TPG, KKR, stuff like that, which would be grossly unfair. And we've seen this movie before. It's hard not to be cynical about it, but that's probably what would happen.
So yeah, I think this is. I think there's more to come from this. We don't know exactly what's going to transpire quite yet. We know there's something on the horizon that doesn't seem quite right. So kind of fascinating, but at the same time very disturbing. Jared, before I let you go, where can people follow you to learn more about this?
You can follow. I have a very, very cool site that is the coolest thing in the world. You got to check this out. It's called shortprivateequity.com. You go there, and if you've ever seen the Drudge Report, it is like a Drudge style website with all these headlines on private equity. There's dozens of headlines. You go there, and this is updated on a daily basis, right? So this is something that I've been doing, and my partners, and it's a really good source of information.
All right. Well, thank you so much, Jared, for your time today, and hopefully keep us abreast on the developments.
Thank you.
That is it for me this week. If you want more stories that the mainstream media is unwilling to tell, head on over to my YouTube channel, 5149 with James Lee. The link will be in the description below. As always, thank you so much for your time today, and keep on tuning into Breaking Points.